A question came in from James. James says, hey, I've been looking at the market recently and now I'm concerned. You'd mentioned in the opening about market hedges. How can I hedge my portfolio? Okay. So the obvious answer is we're talking here about married puts. And I had a coaching session at 3 o'clock today. And it's a gentleman who's using in the money covered call positions to hedge his portfolio. So let's say in the money covered calls, I buy a stock at 100. We sell a 95 call there, and we collect, let's say, $6. Now, I'm agreeing to give up my shares of stock at 95. I collected $6 in premium, so my cost basis essentially is 94. The max I could make if the stock stays above 95, I know you all know this, or most of you know this, so I'm pretty sure all of you know this. The stock stays above 95, my shares get called away, whether it goes to 120, whether it goes to 100, whether it goes to 95.10, it drops in price. I get assigned at 95. So essentially I make $1 per share on the position. Simple math, not really drawn the right way, but in the money covered calls as a hedge, we've got essentially a 6% downside protection. The stock can fall 6% before we're losing money on the position. The trade-off is, of course, we've capped the gains if the stock continues to run. Now, is it better to use an in-the-money covered call or an out-of-the-money covered call? Meaning that we have a stock position trading here at 100. Well, look, I want growth. I'm expecting growth. I want to hold the stock long term. So I'm going to sell 105 or 110 calls 2 weeks out, 1 month out. And I want to collect maybe, I don't know, 50 cents, 60 cents, $1. And I just want to treat this like an extra dividend and have it expire worthless. Well, that's an approach. You're holding this long term. You have capped the upside in case of a long run on the trade. It's an out of the money covered call play. But what you've done is you've reduced the downside protection. You only collected 50, 60, 70 cents. So the stock can only fall 50, 60, 70 cents. So is it better to use out of the money covered calls, hoping to hold the position long term, or use in the money covered calls for the better downside protection? This comparison depends on your personal risk reward tolerance, where you are in your portfolio in your trading years, and your personal goals. If I want to hold a position long term, I want to generate income, but I also want to control risk to single digits. To be honest with you, I'm going to use the married put approach. That's what it's designed for. I'm going to flip this upside down. I'm going to buy a stock and yes, pay extra money to buy a put, but keeping the risk to single digits. I'm going to go following our rules in the full course, the blueprint. I'm going to go 6-7 months out in time. I'm going to go 1 or 2 strikes in the money, which looks expensive, but the most I can lose is 4 or 5% with an unlimited upside. Whereas in the covered call, the most I could gain with an out of the money call might be 4 to 5%. But I'm risking 98% of what I invested in the trade if there's a massive decline. So James asked this question. No, he said, what are ways that I can hedge my portfolio? Why I went this way is the discussion that I had on the coaching session is there's a gentleman who's using in the money covered calls as a means to generate income and hedge his portfolio. It is a good approach. It has its flaws, where in uncertain market conditions, a black swan event, even with a trailing stop or stop order, you're risking more than you possibly thought, even with an in-the-money covered call with a 7, 8, 9, 10% downside protection or percent to break even. If it falls more than that, the market falls more than that, you're losing more. But at least with a covered call, you've got that 6, 7, 8% premium in hand, where the trailing stop, if I buy the stock and set a trailing stop at 1 or 2% and the stock falls 25%, well, that triggers a market order where I get filled at that price at 25% below my purchase. They can't fill me at 1%. Overnight, we're in earnings season, so that's going to happen to a lot of different stocks. We've seen that happen to 1 or 2 stocks, and we've seen 1 or 2 stocks actually jump 20 to 30% as well. Okay? So this is considered a conservative approach in the money covered calls. Conservative, generating income, having protection. The married put approach on the other side, following the rules in the blueprint, flips it upside down where I can't lose, guaranteed better than a stop order, more than 4 to 5 to 6%, and I leave the upside open. Now, where I'm going with this is that the investor I talked to about the covered calls asked me, well, do you do covered calls trading at all? And to be honest with you, well, I think you've heard me say this before, I don't trade covered calls anymore at all. 50 to 55% of my portfolio is in the married put positions. Following the rules in the blueprint to control risk, leave upside open, but what can I still do? I own the stock, I own a put, so at any time I can sell a short-term covered call against it, lowering that initial at risk and potentially bulletproofing the trade where I have no risk on the position. Well, if you're doing in-the-money covered calls as a hedge strategy, a protection in your portfolio, you're probably doing it with 50, 55, 60% of your portfolio. Why? Because these are capital intensive. They involve buying the stock. So what do I do with the other portion of my portfolio? Well, as you all know, 10 to 15% of my portfolio, usually about 12 to 15%, in the right market conditions, which we've been in, but maybe we're turning a little bit, is in the bull put credit spreads. The weekly bull put picks of the day, or I just usually go to the search and I go to the weekly bull puts here. Oh, no, that's from a webinar a few whiles ago, but weekly bull puts here. And what I'm targeting is an 85% theoretical probability with a return of around 14.8 to 15.1% is usually the average, and it's about 87% of the time. But then there's management involved in those positions as well. And these are usually I usually open these on Monday, so they're 11 days out in time to expiration. I do calendar call spreads. What some may refer to as poor man's covered calls. I don't like that term, but stocks that I can't afford to do as a married put. I'm buying a leap call, far out in time, selling at or out of the money calls against it. And that's about 10%, 12% of my total portfolio. So now where are we at? We're at about 70, 75, 80%. Okay. And I may do a little bit of earnings plays here, 2 to 3% of my portfolio, maybe buying calls, but normally buying strangle positions or straddles, buying straddles following earnings ideas, buying straddle positions, long straddles for an earnings play, like a lottery ticket. 2% of the total portfolio, maybe 3% in an earnings season, but in a non-earnings season, that money's away. So when I talk about these market hedges, James, what I'm talking about is extra protection to hedge the 12 to 15% of my portfolio that's in these leverage positions such as bull put credit spreads, which are risking 100% of what I invested into the position, the margin requirement for that trade. So if there is a black swan event and the market falls, I'm risking 100% on this. But if I lose 100%, I've only lost 12% of my portfolio. But you've heard me talk about it before. There are webinars there in the bull put credit spread playlist on the management techniques. And one is we don't, if possible, and I've normally been able to make this happen, I don't allow myself to lose more than 50% of the total risk on a bull put credit spread. When that black swan event happens, I'm out. I just close out. Regardless of what the event was, what happened, because now, even if I was at max 15% on 3 or 4 trades of my bull put credit spreads, even if I close all 3 of them out at 50% loss, my portfolio is only down 7.5%. But how do we counter that? Well, that's what I mentioned. That's what those 2 hedges, that other video coming up that you'll see early next week or over the weekend possibly as well. And one of them is simply buying calls on the VIX. Now, I don't do this consistently. This isn't a year-long trading strategy, trading the VIX. I will buy calls on the VIX typically when the VIX drops below $14.50, $14, maybe even $15 in the current market conditions. And I'm going to go out about 45 days or so here, probably go to March 18th. Yeah, I probably wouldn't go 75 days out, but I'd probably go to March 18th. And I'm going to look for a call that has a delta of about 0.3. And in my portfolio, that might mean 6 to 8 contracts. But now there's a caveat. The caveat is this isn't just a position, as I mentioned, that I'm trading long term. Oof, I don't like it's been up and down the past 2 days. I don't like these prices right now for this expiration, but that's okay. So in this case, I'd probably be only buying 4, and I'd probably be at maybe the 22 strike. Usually I look for a premium around $1 and a delta of 3, but I think our delta of 3 is going to be here on the March 22 call, just as a guess. I'm not even sure. So I might buy 4 here, maybe 6. Yeah, maybe 6. But in any case, this isn't just a trade that I put it on and say, oh, when I hit 50% profit, I'm closing out. This is much more complicated, and you'll see some of that discussion in the webinar, and some of the discussion is available, as I mentioned, in that Market Hedge playlist that I mentioned, James. So back on let's just go ahead and take a look at the chart. Hopefully this comes up for me. This chart has been a little bit wonky for me today. It hasn't come in as cleanly as I wanted to, especially when looking at the VIX. Oh, there we go. What I did on the first full trading cycle here on January 5th, number 1, because we're going to show power options investors how we did the bull put credit spread starting on the first full trading week of 2026 with the weekly bull put credit spreads, covered call picks of the day, monthly and weekly, and so forth. But we bought 8 VIX calls here at this price when it was just because it was January 5th. It was the full trading week. Usually I would have waited for the low. I would have loved to have bought here, but I didn't. I just bought here. We bought 8 contracts, and it was right around 15. I think it was 15.22 when we bought the calls. And we essentially bought the 19s. Oh, I'm sorry. Yeah, it was about the 18s or 19 calls initially. So we had 8. Now here's the trick with the VIX. Usually when you see a spike, you sell, I sell. This is my approach. I'm sorry, you don't sell, I sell. So what I'm doing here is when I get into the VIX calls, when I see the first spike, I usually sell half. To be honest with you, this spike was so fast I missed it. It was this spike. We sold half. So now we have 4 remaining. But at this point, we had canceled the entire cost basis of this trade. So when this spike happened, we took some profit naturally off of those. And then, of course, what happens? That helps hedge some losses that we might have taken on those leveraged portions of our portfolio. And then when it starts to fall back down here, when I see it fall down the next day, I usually sell the other half. So now we're down to 2. And then we get this spike up. We sold another half. And now I'm down to 1. So I've got 1 VIX call left. It's a shorter time frame because this was on January 5th. So I actually bought the February ones, not the March one we were looking at on that last screen. And it's completely, lack of a better term, bulletproof. I've completely paid for all 8 of these positions with these adjustments, and I have 1 left for another spike. Probably going to buy more after next week's expiration, I'm sorry, of my bull put credit spreads. I'm using some of that profit to get into the new VIX calls for the new cycles. Okay. But that's one idea. Now let's go to SPY and talk about a little bit, just briefly, not the full discussion, but what we did then. Let's just go to SPY. And if I was open, oh, sorry, folks. Oh, shoot. I don't know what happened there. Sorry about that. I just must have hit control instead of regular. There we go. All right. Sorry about that, ladies and gentlemen. There we go. All right. So let's look at SPY. And again, I don't have the chain in front of me, so I'm just going to speculate. Similar position with a strangle, SPY, or if you're heavy in tech in your portfolio or in some of the leverage portions. One other idea is the long strangle. I like 49 days. I like April. This is a tough one. Quarterly looks interesting. I'm going to go quarterly at 60 days for SPY. I'm sorry, SPY closed today, of course, 691.97. So I would look at the chain. I'd have the chain in front of me, and I'm going to look for the puts are probably higher now than the calls, delta-wise. So I might, let's just call it, I might be buying a 685 put right now. It's expensive. I get it. You could go shorter term for cheaper if you're expecting a movement. And let's just go the 700. I know that seems wide, but based on what the market has been, that, oh no, it's reversed. I should be deeper down on the put. It should be at the 680 put. And probably I'm going to stay at the 700 call. That's fine. All right. So let's go ahead and talk about here what we're doing. I said I wanted the 680, not the 685. We're going to buy both of those. We're just going to buy one contract. So this is going to be $2,500 investment, roughly. And to be honest, I know what you all are going to say. This looks like a terrible trade. And I agree with you. You've heard me talk about webinars comparing different strategies, and I refer to this area whenever we see this on a ratio spread, or we talk about it with back spreads or things of that nature. We talk about it with the straddles or strangles. We talk about leverage trades. No man's land, Death Valley. This area here between 724 and 655, the probability of making any profit on this particular trade by itself is probably, I'm going to be honest with you, 2%, 3%. This is not a strategy to put on and fire and forget. This requires management. You're using it as a market hedge. And what I mean by that is if SPY pulls down to 670, 677, the profit on the put is going to outpace the loss on the call at not the halfway point between now and expiration, but sometime soon. And then what I'm going to do is just re-bracket the strangle. I'm going to take that profit on the entire trade off, and then I might buy a 650 put and buy a 690 call. And now the stock moves back up. And so now we've got another profit here. So I'm going to readjust again. I might be buying a 710 call, and let's just say 670, for example, put. But each time I'm doing this, I'm taking profit on the trade that's hedging losses I might be taking on the leverage position, and I'm getting closer and closer on the year to this. We have a no-cost strangle as we keep rolling it up and down with the market. We've already rolled the initial January 5th strangle twice. When we did drop down to about 677 here, we adjusted that, took the profit off the put. These were different strikes than we had at the time. And then when we moved back up here to the 699 range, we moved the strangle back up this way to the different strikes. So that is a recurring hedge that I use, but it only represents a small portion of my portfolio. And it only represents a small portion of my portfolio because it's designed just to hedge the unknowns and what if scenarios on the bull put credit spreads and the calendar spreads, the leverage portion, of my portfolio. That's what we're looking to do. That's the other presentation you're going to see, James. That's what I'm referring to as alternative market hedges. And of course, again, you can just go to our YouTube channel on YouTube at Power Options. And there's the full playlist there for market hedges for unexpected events, earnings, and more. Click on view full playlist there. Review of VIX. I apologize. This is a market hedge. And current look at the market sentiment, comparing stock hedge strategies, something that we, another thing we just discussed here a little bit earlier for Lance, but we didn't discuss it, but it's going to be discussed. And this is the fun one. This is comparing hey, I want to hedge the market in case of adverse conditions. Should I just buy a put on SPY? Should I just buy a put on QQQ? If I'm heavy in gold and silver, which many of us might have been during the run, should I have just bought puts on gold or silver? Can I lower the cost of just buying a put? How about a bear put debit spread as a market hedge? How about VIX calls? How about other approaches? So we walk through that here. It was an initial question that came in. It was 4 years ago from one of our regular webinar attendees, of course, and one of our Power Options subscribers, who said, hey, I'm looking to hedge the market. I want to cut the cost of buying the puts in this market. Is a bear put debit just as good as buying those positions?